Hey everybody, welcome into the show. Captain Seth and Uncle Paul is here. Today we're talking about Ferrari. My children are enamored with luxury cars. I think a lot of people growing up just fall in love with these amazing cars. Ferrari's been an incredible Italian company for many, many years. And we look at the health of a company. The stock price has been doing well of late, and we like to look at the health of the company. We're going to look at using our 8-pillar analysis. Paul's going to take you through an in-depth financial tour of the health of Ferrari and potentially see if this is a buy or an avoid. Paul will take you through our 8 pillars. Paul, how are you? Welcome to the show.
I'm wonderful. Ferrari is pretty exciting, isn't it?
Yeah, you get fired up about these cars. You don't own a Ferrari, right?
I don't, but it's something I do want to.
What is one of your dream cars? You never drop $400K on a car, would you?
No. I mean, would I? I mean, I'm sure at some point in the future, but right now I'm not. I have no desire to do that.
But if you're going to today, where would you go? Would you go to Ferrari?
Yeah,
or?
absolutely.
Really?
And the reason being, it's just such a classy car. Like it's just,
Do you like the red?
It doesn't bother. I like white a lot.
You do?
They have that like off-white kind of creamish color.
Yeah.
There's a I think if I ever do a convertible, I would do a Ferrari.
Join us later. We'll talk about the Patreon giveaways we're doing this year. We are talking about cars, so we will be giving away 2 Tesla Model 3s, 2 of them, to patrons this year. So stay tuned. We'll talk more about that. And I think one day we will be giving away something as large as a Ferrari or Lamborghini or something incredible. But Paul, let's get into this company. That's what people came for. This Italian company, founded in 1939. Amazing. What is the market cap for this puppy?
$50 billion, pretty much on the nose. PE ratio, Uncle Seth, look at this number.
Tell me about it.
65. That's an X right there.
That's an X.
But they quickly redeemed themselves with a wonderful margin. The last 12 months, their margin's been about 16. Let's see, what is that? It's over 10%. The bottom line, it's over 10%. It's a check mark. On $3.7 billion in revenue, they did $580 million in profit. So we have 1X on PE and 1 check mark on the profit margin, and this cute little adorable dividend yield of 0.6%. So on $50 billion, that's $300 million. Now, Seth, why does it matter for us to look at the dividend yield?
So this was news to me that the dividend, although sometimes stated by companies, and there's tons of YouTube videos about dividend trading, but this is not a guaranteed number from year to year. This can certainly change. And so there are also things like dividend traps where companies can overly maybe expand on the number they're looking to give you, but they don't have the free cash to support it. Am I right, Paul?
Correct. So what we do is we look at the free cash flow to determine if the dividend is supported. This company has a $300 million a year dividend. We want to make sure they can easily support that dividend, because what companies will do is when the stock price is lagging, they know people will look at the dividend and say, oh, this is wonderful. They might take on more debt or issue more shares in order to pay that dividend, which hurts you as an investor today, right?
Yep, that's
so we want to make sure it's easily supported. So right now, let's move on. So we have 1 check and 1X so far.
Pillar number 3 is revenue growth over the past 5 years, Paul.
Okay. Now remember, this is going to the end of 2019 because 2020, even though it's done, has not been officially put in the numbers yet. So we're at $3 billion to 4.1. Check mark there, 33% growth in their revenue.
How about profit growth, pillar number 4?
The profit growth has gone from 319 million to 778. Check mark there. So even though the revenue is up only 33%, their profit is up well over double. So that's pretty awesome.
How about shares outstanding is pillar number 5? We want to see if they're selling off more shares or buying them back, Paul.
Okay, pretty much even. 188.9 to 186.8. Check mark there. So remember here, guys, what we're trying to do on shares outstanding is, the reason this matters, no other investors really look at this, but it matters to me. I want to look at what's the company doing to protect me as an investor today. So as an example, let's say there are 10 shares outstanding for a company and you own 1. You own 10% of the business, 1 share out of 10. Now let's say they issue 2 more shares. It goes to 12. How many shares do you own? Uncle Seth?
Still 1.
Still 1 share. But now you own 8.33% of the company, 1 out of 12. That is how they are hurting you by issuing more shares. If they take shares away, and let's say they buy 2 shares back, go down to 8, now you still own the 1 share. Now you own 12.5% versus 10% of the company.
If you're confused a bit, this has nothing to do with a stock split.
Not a stock split. It's them issuing more shares to do something with it or buying shares away using their free cash flow. You want to find a company where it's at least staying the same and going lower. They're going to take their free cash flow and they can't invest it at higher returns. One way to give your investors more return is buy shares back. That makes your investors own a larger percent of the company than before. Now, does that mean that if they're issuing more shares, it's always bad? No. Just like everything, and just like buying shares back isn't always good. If the shares are very, very pricey and expensive and they're buying shares back, to me, that tells me they're not understanding what money is really doing. They're investing their money at a low return, and I don't like that either. So overall, though, that's why it's one of the pillars. I want to make sure they're at least focused on you as an investor and see how they can increase the value for you as an investor.
If you like what you're hearing so far, make sure you tickle that thumbs up. We really appreciate it. Tickle that thumbs up. We love ya. Pillar number 6 is current assets over current liabilities, Paul. Why is this important?
So this is important. I like to look at this to say, do they have enough cash on hand to at least pay their current bills? They have currently $3.5 billion in cash and current liabilities of $826 million. Chickadee, 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 check. They have plenty of cash left over. And overall, they only have $5.2 billion in debt. So $3.5 billion in cash versus total debt of $5.2 billion. I'm not saying that's good or bad, but for me right here, I look at it going, oh, it's pretty reasonable to not have that big of a difference.
Pillar number 7 is our most important one. This is free cash flow. We want free cash flow growing from year to year.
Okay, so now remember, free cash flow is cash from operations less your capital expenditures. This is the money the company will have left over to pay the dividend, buy shares back, use it as cash to pay off, to purchase major acquisitions, things like that that'll help the investor overall make the company's financial health look better. So 5 years ago, $390 million, and recently about $700 million.
No.
Oh, wrong one.
Check mark there.
I hit the wrong sound drop, Paul. It's hilarious. Go ahead. What's the second number? 700 something?
700 million roughly.
700.
And I'm rounding. It's a little bit off, but bottom line is there is growth there.
Check, please.
And over here for the other years, it's about 730 million, 310 million, and 350 million.
Okay, the average free cash flow year to year over the past 5 is around 500 million, Paul.
Now here's the deal, guys.
Wow.
What we're trying to do here is figure out what multiple of free cash flow we want to pay. If you look at the history here, there is growth, but it's a lot of ups and downs. So it's inconsistent, right? Do you see this, Seth?
Yeah.
390, 730, 310, 350, 700, right? A lot of inconsistency. When I see inconsistency, I want to pay a lesser multiple of free cash flow. That tells me I need to make sure I'm cautious about this. Even though there is growth, I want to be cautious about inconsistency. But this is also a very, very exclusive brand.
Yes.
It's Ferrari. There should be a premium paid for a very, very good brand.
Typically, other brands, luxury items, don't get hurt as much in recessions because wealthy people are still buying them. They're still buying Dolce & Gabbana.
Yeah.
Dolce & Gabbana belts and... I'm going to get roasted in the comments for that one. I don't own one. I know you have a series of belts, beautiful belts.
I do not.
You wear that white belt that freaks me out all the time.
Which white belt?
Don, doesn't he wear a white belt that kind of like makes us look weird? You love this one white belt. You don't remember it?
It's a golfing belt.
Okay, well, I move on. That's not why we're here.
It's like a Nike golf. Is that the one you're talking about?
Probably.
It's like a $40 Nike golfing belt.
It's just creepy. Sometimes a white belt. Listen, get into these luxury.
We got McGiggles over here.
I'm just picturing you in that little white belt.
I'm trying to remember what belt this is.
Hey, you look like an Oompa Loompa. Talk to me about luxury brands and why they're not affected as much.
The multiple we do here usually is 20 times.
20. Yeah, so folks, if you're watching, we want to take our free cash flow and multiply it by 20 to get our desired market cap, and we compare that to its current actual market cap.
So 20 times is like this 20 PE. Over long periods of time, earnings and free cash flow should equate out. So if we multiply earnings by 20, we should multiply free cash flow by 20. 20 times 500 is 10 billion. The current company is 50 billion. It is massively overpriced. I've thought this. I've looked at Ferrari a lot in the last year. It's expensive, but this is a company I want to be part of.
You can't stretch that far, Paul. Not from 10
No, I can't
billion
stretch
to
5 times. Because
no.
to me, if there was a lot of growth, 30, 40, 50% a year, I'd say okay. But Ferrari's a pretty established brand. They're not growing 30, 40, 50% a year. In fact, in revenue, they only grew 33% over a 4-year period from 2015 to 2019. So you look at these things and say, okay, These are all part of the art of investing. There is no set number that's correct. There have been some companies we sit there and say, listen, you should only pay 10 times free cash flow. There's other companies who sit there and say, hey, you should pay 25 or 30 because they're growing so fast. I don't know what the right number is for Ferrari, but bottom line is if you multiply by 20, you're still at 10 billion. Even last year, let's look at the trailing 12 months. Let's see what they did in the last 12 months. This would be a COVID time period. What have they done in free cash flow over the last 12 months? Wow, barely any. 906 less 830. $70 million in free cash flow in the last 12 months.
Check it again, 70 million compared to 700?
70 million versus 5. But again, I'm not sitting there, this is COVID. Even during COVID, everyone was hurt. I think even though during bad time recessions, luxury items aren't hurt as much, but COVID was such a dramatic fall because you couldn't even go out there and buy, you were like shut down from even selling stuff. That's the other thing. Like, you couldn't go to Louis Vuitton and buy clothing because they shut the stores down. You couldn't go to Ferrari dealership and buy a car. They shut the. Now, ironically, there's a local used luxury car dealership that I think is the #1 in the country.
Here in Cleveland or in Columbus?
Here in Cleveland. And they said they had record sales because they do so much over the internet.
Yeah.
The bottom line is in this company is, I think there'll be a time, and by the way, it makes sense. Their PE was 65. And their free cash flow is about 80 times. So they're pretty much in line here. You got to see that PE fall. Can you pay 20 times earnings? Yeah, maybe you could justify that saying, listen, it's a very luxurious brand. It's very stable. The demand for it, they do a good job of keeping they're like Louis Vuitton. Louis Vuitton, when they make too many purses that they don't sell, what do they do with them?
They burn them or something?
They burn them. They get rid of them. And their whole goal is we don't want discounts. We want people who are going to pay full price, protect our brand. Same thing with Ferrari. In fact, if you want a red Ferrari, the wait list is insane.
Come on.
If you want a new red Ferrari, you can't just go, oh, I'll take that one in red. They're like, okay, congratulations, have fun. We have it in white for you. We have it in blue. We have it in black. You want red? You're going to wait.
Wow.
So they really protect that red Ferrari brand. They protect the brand. I don't know how many, do they even, I think it's like 8,000 cars a year they build. How many cars a year do they build?
It's on pace with Workhorse for sure.
Let's see here. How many cars a year does Ferrari build?
While Paul's looking at that, make sure you tickle that thumbs up.
8,400.
8,400. You're right, Paul.
Approximately 8,400 cars are sold each year after being built in Maranello, Italy. Maranello, I don't know how they pronounce it.
Interesting. So final take. It's at $200 today, Paul. You want to see the stock price drop to what before you're maybe even thinking about buying this?
50.
50
Yeah, I know. It sucks, guys. It hasn't been a 50. Even during the pandemic, it didn't hit 50.
In 2017, it was around 50, some 2016.
I know. It sounds hard. You're probably like, this guy's always talking about. Guys, your job is to find the 10,000 companies and find the 20 or 30 ones that fit your schedule, fit your numbers, but the ones you like, put them to the side, put your price target in place, set it so that when it hits the price target, it'll notify you. Our software will be able to do that for you at some point in the future. This is a very important thing. I just look at it going, guys, be patient. There are always better times to buy companies. All companies go on sale at some point.
If you're drawn to this in-depth analysis and mathematical look at companies, you can join us on our Patreon. The link is in the description below. Our Patreon is growing crazy. We have over 750 members now. If you feel lonely out there in your decision-making about investing, that's where I was for almost a decade, and I have a lot of very intelligent doctor, lawyer friends who also feel lonely. So if you feel lonely, join our Patreon, join our group, and you'll get access to Paul, myself, Patreon exclusive videos, and a community where you can discuss. Paul.
We also want to talk about options. We want to get more in tune with options, correct?
Yeah,
so
Paul.
You mind if I talk about the options here?
Yeah, go ahead, Paul. This is interesting.
So we have options right now. And what I do is I use options as a way of buying companies at prices I want and being paid to wait. So what that means is, and I'll explain it to you in this video here. Let's say hypothetically, a company is selling for $50 a share, and I want to buy it at 40. What I would do is I would close out all these windows. I would sit there and I would sell an option at $40 at some date in the future. That way, if the stock falls below there, I'm forced to buy it at 40 bucks. And I collect a premium. Let's say it's $1. I don't know what the premium will be. It depends on volatility, all these other factors. Somebody's gonna pay me $1 to wait until the stock goes to 40 at some date in the future. Let's say March 2021. So I have to wait 45 days roughly for this stock to fall. If it stays above 40, I keep my $1. I don't get the shares. If it goes below 40, I still keep the dollar, but now I'm forced to buy it at 40 bucks. What's the risk? The risk is it goes to 35, I'm still paying 40. But in my eyes, if I was willing to buy it at 40, this isn't a risk. I was gonna buy it at 40 anyhow. When it goes to 35, I still lose $5 anyhow. Except now, I'm paid that dollar to wait. Okay, so let's look at Ferrari options in the future. If I think it's worth 50 bucks, let's see how garbage, because it's gonna be a pretty low number. Let's say we're going to Ferrari, and it's currently at $202 a share, and I wanna sell a put for January 21st, 2022. I can't even buy a $50 put. The lowest price I can do is $80 on my Charles Schwab Street Smart Edge. And even if I wanted $80 a share, I'm only gonna get paid 65 cents or so to wait for that stock to hit. So my return is garbage. It's 65 cents on $80, less than 1% to wait 352 days, almost a year. So for Ferrari, waiting, I'm not gonna even sell this put. I'm gonna wait until it gets closer to the price and then start selling at that level to wait to get the higher premium and get a good return on my money in order to wait and take the risk.
If you're confused about this, again, you can join us on the Patreon. Tons of people talking about this. This has made waves in the Patreon, Paul.
Our highest Patreon group that was paying $100 a month for us.
Yeah.
Everybody in there is like, just the thing they've learned from the options have made them many times that amount every single month.
Yeah, it's incredible. All right, Paul, that was Ferrari. Yeah, you guys are incredible for watching us all over the world. We appreciate your support. Our subscribers have been growing like incredibly, and we're very appreciative. So for now, it's Paul and Seth on the Everything Money channel. We love you guys. Thanks so much. See you
You're
next
real.
time. See you guys.